Somewhere in Ohio, a woman named Marisol is standing at a gas pump with a card that won't work. She isn't broke. She has $340 in her checking account, but she also has a gym membership she forgot to cancel 11 months ago, a subscription she doesn't remember signing up for, and a bank that processed both of them this morning before her paycheck landed. Her balance is -$7. In the next 90 seconds, her bank is going to charge her more in fees than the amount she actually overdrew by. That single moment, $7 turning into 40, is where this story begins. And by the end of it, you're going to understand something most people never get explained to them in plain language. Your bank is not one institution. It's 8 different institutions wearing the same logo, and which one you get depends entirely on a number most of us never think to ask about. Before we get into how Marisol ends up on the wrong side of that machine, one quick thing worth saying plainly. This documentary is for educational purposes only. I'm not a financial advisor, and nothing in this video should be considered financial, investment, tax, or legal advice. Always do your own research and consult a qualified professional before making important financial decisions. Let's start with what actually happened to Marisol, because millions of Americans go through some version of this every single month. An overdraft happens when your bank pays for a transaction even though you don't have enough money to cover it, then bills you for covering the gap. It sounds like a favor. In practice, it's a short-term loan you never applied for, and when you measure the fee against how small the actual shortfall usually is, it becomes one of the most expensive forms of borrowing available to an everyday consumer. Legal, disclosed in your account agreement, and still strikingly costly for what it is. As of the most recent industry data, the average overdraft fee in the United States sits at roughly $27 per incident, down from a peak of nearly $34 a few years ago. Banks have been under real pressure to bring that number down, and some finally have. A handful of major banks and online-first institutions, names like Ally, Capital One, and Discover among them, have eliminated overdraft fees altogether. Your card simply declines instead. But plenty of banks still charge close to the old maximum. And here's the part worth knowing. Federal regulators did finalize a rule in late 2024 that would have capped overdraft fees at $5 for the largest banks, the ones holding more than $10 billion in assets. Congress voted to overturn that rule in 2025 before it ever took effect, so today there is no federal price ceiling on what a bank can charge you for an overdraft. Whatever protection you get largely comes down to which bank you chose, not a law protecting you from the size of the fee. Here's the part that should make you angry, and I mean that in a useful way, not a dramatic one. Research from consumer finance analysts consistently finds that around 9% of account holders generate roughly 80% of all overdraft fee revenue. This isn't a tax that falls evenly across everyone who banks in America. It's concentrated almost entirely on people who are already living close to zero. The same paycheck-to-paycheck reality that causes the overdraft is the reason the fee lands so hard. If you had breathing room, you wouldn't overdraw. Because you don't have it, the system charges you for not having it. That's not a conspiracy. It's just what happens when a fee structure isn't built to scale with the size of the problem. Whether you're $7 negative or $400 negative, the mechanism doesn't care. It activates the same way either time. So how do you actually get out from under this? A few things work, and they're boring, which is exactly why they work. Most major banks now let you set up low-balance text alerts for free. Turn them on. Linking a savings account for automatic overdraft transfers usually costs far less than the fee itself, sometimes nothing at all. And if your bank still charges the old $35 rate with no grace period, it is genuinely worth shopping around because several competitors now offer checking accounts with 0 overdraft fees as a core feature, not a promotion. That single decision, which bank you choose, can be worth hundreds of dollars a year to someone living paycheck to paycheck. It's one of the only places in personal finance where the fix costs nothing and the savings are immediate. But that's only the entry point. What actually determines how your bank treats you has almost nothing to do with how much money is in your account today, and everything to do with what your account looks like over time. Banks run on risk models. Every decision they make about you, your fees, your rates, who answers your phone call, is downstream of one question: How much does it cost the bank to keep you as a customer, and how much can they earn from you in return? Once you understand that single mechanic, the entire system stops feeling personal and starts feeling like what it actually is: a machine responding to patterns. Take Marcus, a 41-year-old warehouse supervisor in Phoenix. 2 years ago, he was exactly where Marisol is now: negative balances, minimum balance fees, eating into an account that never had much in it to begin with. At many traditional banks, the minimum balance requirement to avoid a monthly fee typically falls somewhere between $500 and $1,500. Drop below it, and you're often charged a maintenance fee in the $10 to $25 range, whether or not you did anything wrong that month. It's rent for the privilege of not having enough money. What changed for Marcus wasn't a windfall. It was consistency. Steady direct deposits on time every 2 weeks for about 6 months. That's it. And the bank noticed, not with a phone call, but algorithmically, the way these systems always notice. His fee waivers kicked in automatically. Pre-approved credit offers started showing up in his app. This is where everything changes, and it changes quietly. Here's why this matters. Credit cards issued to people with limited credit history typically carry interest rates in the low to mid-20s, sometimes higher, because the bank is pricing in uncertainty about you as a borrower. That's not personal either. It's actuarial. But it means your first card is rarely your best card. If you pay it off in full every month, the interest rate becomes irrelevant, and what you're actually building is a track record the bank's models can read. Do that long enough and something interesting happens. The same bank that charged you 24% for a small credit line 2 years ago might offer you an auto loan closer to 6 or 7% today. It's the exact same institution. The only thing that moved is the data attached to your name. I'm John, and if the idea that a bank's risk model is quietly rewriting the terms of your financial life is new to you, you're exactly who this channel is for. I break down how money systems actually work in plain language, so subscribe if you want the rest of this story, because what happens once real savings enter the picture is where most people completely lose the plot on how banking works. Because savings change something that income alone doesn't. A standard savings account earning the current national average rate, which hovers around a fraction of 1% annually according to FDIC data, is barely holding its ground against inflation, and a basic checking account typically earns close to nothing at all, while that same bank turns around and lends deposited money out for car loans, mortgages, and credit lines at rates many multiples higher. That spread, what a bank pays you versus what a bank earns off you, is the actual business model of retail banking, and it exists at every single tier. The difference is that once your balance grows large enough, banks start competing to keep it instead of just quietly profiting from it. Somewhere around the 6-figure mark in combined savings and investments, unsolicited credit limit increases start arriving without you asking. Loan rates improve, not because a human likes you more, but because a bigger, cleaner financial history is measurably less risky to lend against. This is where a version of leverage starts to appear. If you tell a branch you're thinking about leaving, someone will often try to keep you with a better offer. That conversation simply does not happen at lower balances because there's nothing yet to retain. Push further into what the wealth management industry generally defines as high net worth territory. Investable assets north of roughly $1 million, and the relationship structurally changes again. You're typically assigned a named advisor. Mortgage rates quoted to you can run meaningfully below what a first-time borrower sees, sometimes enough over the life of a loan to represent tens of thousands of dollars in difference, because the underlying risk truly is lower and the bank wants the broader relationship, not just the loan. Go further still into the tier private banks reserve for their most substantial relationships, and the products stop being publicly listed at all. Rates get negotiated individually, documentation gets expedited, and a small team is assigned to protect a relationship that shows up as a line item in someone's performance review. None of this involves banks breaking rules. It's the same discretion available in every account's fine print, applied generously to relationships the institution doesn't want to lose, and applied rigidly to the ones it isn't worried about keeping. So here's what actually matters for you, watching this today, wherever you currently sit in that system. The banking hierarchy isn't a reflection of who deserves better treatment as a person. It's a machine reading risk and revenue, and the inputs to that machine are things almost anyone can influence over time. Payment consistency, account tenure, a shrinking reliance on credit, a savings balance that grows instead of resetting to zero every month. None of that requires a windfall. Marcus didn't get a raise that changed his life. He got 6 consistent months, and the system reclassified him. That's genuinely how much of this works, which is either the most frustrating fact in personal finance or the most useful one, depending on what you do with it. The biggest advantage in this entire system was never simply having more money sitting in an account. It's understanding that the system is reading you the whole time. Every deposit, every missed minimum, every month you don't overdraw, and slowly building a case for how you get treated next. You don't need to beat that system. You just need to know it's grading you so you can start handing it better answers. Somewhere tonight, someone is standing at a gas pump doing the same math Marisol did. The system that embarrassed her today is the exact same system that, 6 consistent months from now, could start working quietly in her favor. That's not a guarantee. It's just how the machine is built, and now you know how to read it.